And good morning, everyone. I'm Randy Price. This is the Price Group. Another day in paradise here in Houston. If you're not in Houston, count your blessings. The weather report continues to be hot. This is our halftime event, something we've done for several years. We enjoy doing. We've titled this year The Great Reopening. Happy to report that things are reopening, and it's created its own sense of situation and circumstances. But our goal is to educate with this webinar, educate with perspective, information that serves a purpose, information that is helpful to you and your family with regard to your financial and wealth planning. For those of you clients, we know we do this on a regular event. For those of you joining us that are not clients, we also do a end of the year recap. So we try two times a year to give a big picture perspective. Hopefully you find this, some of our other communication, very, very helpful. We're here to help. And with that, let's press forward. Who are we? We are the Price Group, family owned and operated. We serve as a fiduciary. Our niche is in the retirement investment planning. Today, Matt Price will be joining us, obviously, along with myself. And we'll be going through the slides. Our goal is about 42 minutes, leaving some time for questions for the group as well.
And I'll brag a little bit on Randy. We've been very humbled to receive accolades from Barron's, Forbes, Financial Times over the years. Recently, just this past week, we'll send out an email here in the next few weeks, but Randy was awarded again the Forbes Best in State, Best in Texas, one of the best advisors, which we were very humbled by. You'll see on our weekly emails, for those of you that are receiving them, we send out a quick little Wealth Coach podcast. Randy and I both, we went to the University of Pennsylvania School of Wharton, get our Certified Investment Management Analyst designation. We're both CFPs. We think education in what we do is really important. And we've tried to stay on top of that, having both two CFPs, two CMAs on our team. And Maddie Kearns, who's a real important part of our team, is also in the process of getting his CFP, which we're really excited about. So, quick look, we're going to be talking today where we've been, where we are now, where we may be going over the next few minutes.
So for those of you that have joined us before, you know that we're a little bit corny with starting little brain gymnastics to get things started. Several of you may have been to Broadway to see shows, so that's the theme for today. On Broadway, rows of seats are designated using letters of the alphabet except one letter. What is that? Drum roll, please. I bet some of you will get this. The answer is I. Some people were worried that the letter I would be mistakenly looked at as a number one. And so in Broadway, there are no rows of I on there. So which Broadway show has been the biggest moneymaker of all times? I took this quiz and unexpectedly got that right. Answer would be 3, The Lion King. Been all over the world, and again, great story and a nice show as well. Its director was the first woman in Broadway history to win the Tony Award for Best Director of a Musical. So anyway, there we go. Your brain teaser, your quizzes to get started. Matthew, we're warmed up. We're ready to go. Where have we been, sir?
So one of our favorite slides that we like to look at once or twice a year is this, how markets trend. And we think it's really important because if you look back at history, bull markets, green is bull, bull is good, red is bear, bear is bad. Bull markets tend to last 15 to 20 years. And you can see that with this green period here. You can see that most recently from the period starting 1981 all the way to 1999. Where are we currently in that period? We think the current bull market started in the spring of 2009, which we think it would leave anywhere from 3 to 8 years left in the current bull market. So we get the question a lot, are we in a stock market bubble? Are stocks about to roll over? We can guarantee you this, we will have stock market pullbacks. That's a certainty. That's the price you pay to own equities. But with that being said, we don't think we're at the end of the bull market as of today.
So when we talk about stocks, if you're not invested in stocks, typically you want some income, specifically, especially if you're retired. And so we'll talk about fixed income bonds, if you will, and bond prices are at an all-time high. Remember, there's an inverse relationship with the price of a bond and interest rates. So when interest rates go really low, bond prices go really high. So we have U.S. Treasury bond yields still at about a 70-year low. Today, the 10-year U.S. government bond about 1.3%. That's been really interesting to watch, unusual, if you will, from a long-term perspective, especially with some of the things that the Federal Reserve and the government has been doing. Negative yields, which would be after inflation for 5-year treasuries, and there are some actually negative yields for bonds across the globe. And we've had an unprecedented flow of capital into bonds over the past few years. As we look at this next slide here, some people would say, well, I'm a bond investor. Okay, talk to me about that. Well, bonds are safe, right? Well, let's look at 3 periods of time. Historically speaking, 1920 to 1940, your treasury notes made over 6%. From 1941, remember what happened? This was starting of the war. The country was spending a lot of money. And that period, the real return, the return after you factor in inflation, in other words, if you have 3% rate of return on a bond and you have 4% inflation, you have a negative yield of minus 1%. So the second period there, 40-year period, long period of time, obviously, you didn't do too well if you invested in fixed income. And then the third period, following some stagflation in the 1970 period, you got into a period where, again, you were a fixed income investor. You did very well. You could live probably on 6%. So from 1982 to 2009, again, notice a long period, the Treasury notes did very well, especially on a real rate of return. Now, door number 1, door number 2, door number 3, this is interesting, great information. What does it have to do with my financial situation? Well, everyone is asking the question, well, where are we in the interest rate cycle now? We're in 2021, actually halftime, we're over halfway through that. And it's hard to believe 2021 has come and gone so quickly. But the key question is not where we've been. We know that with great accuracy. It's where we are going. And so through our education, through our fixed income process, through the way we manage money for clients who need income, our goal is always to try to be forward thinking. We are forward thinking. And again, this is good perspective and hopefully gives you an idea of the need for an investment process for the fixed income. The way fixed income was managed historically, we don't think is going to work as well going forward.
I'm reminded, Randy, of a story. We have had a client for over 30 years, and I called her by name and I said, interest rates could be moving higher. And she said, sweetheart, I've been retired longer than you've been alive. Interest rates aren't moving higher. And she was right in the fact that she had been retired for over 40 years. But with that being said, it's kind of hard to wrap your mind around because a lot of clients, regardless of how long you've been retired, have not been in a rising interest rate environment. So we'll talk about that a little bit more here in a few minutes. But we, like Randy said, we titled this The Great Reopening. Let's look at a few pieces of why that is. Earnings growth over the past year or so has been really robust, to say the least. Almost 9 out of 10 companies have reported earnings higher than their estimates. We think that's really important. And when we strip out the noise, and there's so much noise going on in the world right now, surrounding the economy, surrounding political agendas, et cetera, companies will continue to have higher stock prices if their earnings can continue to grow. And that's at the most basic fundamental level. One could say that's oversimplified, but that really is how the stock market, how company stocks will continue to move higher, is if they can continue to earn more and more money. So with that being said, obviously looking 12 months ago, you have a pretty low bar. Just with halfway through 2020, the world was still, for the most part, closed, but happy to report a lot of companies have beaten their expectations. Another big part of why we think the stock market has done so well is the fiscal stimulus that you have seen. 5.3 trillion, what's $1 trillion between friends? We think this is a really good short-term sugar high fix. We think this is not good for my children, my grandchildren. This is not a good long-term solution looking down the road. So there's two more stimulus plans that have been talked about yesterday. It looks like one of them will be moving forward, but we'll wait and see on the second. And looking at speculation, that's a word that, it's kind of the bad S word in our office. We're investors, we're not speculators. And you've seen what we, in our humble opinion, more speculation than normal in the market as of late. Some of the meme stocks would be a GameStop and AMC. You've seen some of these retail investors in some of these online chat rooms talk about how they are going to inflate a stock price, and there's this herd mentality. Everyone's buying these stocks. By the way, this is not a recommendation for any of those stocks mentioned, but there are some extreme high valuations, not we think in the overall market, but with some certain stocks that we have not recommended to any of our clients. Everyone's probably seen on TV or read about some of the SPACs, an alternate way to bring companies public, and you've seen a much higher count of these speculative investments over the past year or so when compared to history. So once again, we don't think there's an overall bubble in the stock market. We do think there are pockets where we would have some cause for concern moving forward.
Good news, bad news here. Home sales are way up as people sort of rearrange the way they look at the world, given the pandemic, et cetera. 5.8 million homes sold. The average increase in price over 23%. So the good news is that people were buying houses. Obviously, low interest rates have allowed people to buy more house than historically they have been able to afford. And the low interest rates translated obviously into low 15, 30-year mortgage rates. Your property taxes are up would be the other part of that. So anyway, part of what's going on is a little bit of reorientation. 5 cities saw population decline. No big surprise there. New York, Los Angeles, San Jose, Philadelphia, Chicago. You've seen people move out of some of the big places and want to move to to smaller cities outside, part COVID related, part just the way some of the cities, states managed through the pandemic. So interesting times to say the least. Another thing that is we look at New York, the rents were down in New York, but they were up in some other places. And they say the trend is reversing, but again, when people leave, the law of supply and demand takes over, and it may take years for rents to in the expensive urban areas to return where they were before the pandemic. So, and that brings us to the present, where we are right now. Matt, talk to us about inflation.
Yeah, we think you've heard the word transient used a lot on TV. We've probably written about it in a few blogs, anything you read online in the newspaper. We think part of inflation is transient, but a big part of it is here to stay. This is what we thought was a really interesting quote. Inflation is still increasing. Economic and earnings growth are accelerating, and monetary and fiscal policy, i.e. what the government is spending, is very, very supportive. That's a combination we've seen only 10 quarters in the past 60 years. So we think there are some good things in the short term. We'll talk more about inflation in a minute. But here we're looking, the economy has continued to grow. What we're looking at, draw your attention to the light blue line. This is the GDP, the gross domestic product, a measure of the complete and total output of the country. What is we find rather startling is look at 2008 and look at the minor reduction that you saw with a slow and steady rise back compared to last year, and how sharp this drop was just with the whole country and also the world closing. It's something, a sharp fall, but at the same time, it has been a sharp recovery as well. Unemployment is improving. You're seeing that. There's actually more jobs available than people who are unemployed, which is a little bit of a head scratcher, but you're seeing month over month these figures slightly moving lower, which is obviously a good sign. And then looking here at saving and spending, 2020, everyone was kind of locked up in their house. You can see this yellow is the personal savings rate. Savings were at an all-time high, spending was at an all-time low, and you've seen the flip opposite this year. Spending is at an all-time high, saving is at an all-time low, which is to be expected. Kind of think about it as a slingshot. You pull back the slingshot with a little marble or whatever it might be in there, and once you let go, you're going to have more, with more money saved, you're going to have more money to spend. You see if you follow any of the numbers of how many people are in airports with the TSA screenings, et cetera, a lot of people are traveling, a lot of people are eating out again, a lot of people are just ready to get back to life as normal, and that involves, obviously, spending money.
I call that the cabin fever slide. So one of the unfortunate things about pressing stop to the economy and then pressing start again is that there are supply chain bottlenecks and shortages. I was talking to some people about trying to get shoulder pads for some of their kids' football activities, and they were stuck on a ship or couldn't get through the port or whatever, and the parents are worried that they want to have shoulder pads before football season. But Matt had bought a car and had a problem under warranty, and still now, what are we, 4 weeks into waiting on some brake parts, but shortage of materials, higher commodity prices. We've seen the price of oil, which is good for Houston, come back into the 60s. Transportation challenges, finding people to deliver things to work, labor issues, et cetera. So this has again been a little bit bumpy. Other direction, please, sir. On that. So okay. So inflation is rising faster than expected. As we look here, everybody asks the same question: is this inflation going to last, or is this just sort of a couple quarter from the bumps and bruises of trying to start the economy? Key question, and a lot of people are debating that. Articles being written about that. The real surprising thing also has been the interest rates. We hear people ask all the time, well, the government's printing all this money. When are interest rates going to go crazy like they did back in the 80s? And if you were around in the 80s, you remember that short-term interest rates, money market was paying over 21%. You remember that the mortgages were double digits. You remember that the 10-year U.S. government bond got to be about 15%. Today it's 1.3. So way down. Inflation has popped for several months. The jury's still out on whether that continues and we get into a full-blown inflation period like we did in the 70s, stagflation, whatever. You see commodity prices going up, but you still have, if you're a business, you still have low cost of capital, interest rates being low, and labor costs are rising, but capacity utilization is still is moving higher, but it's still not an issue yet. But something to keep our eye on, and certainly one of our inputs as far as the way that we manage both the stock as well as the fixed income portfolio. So, and that brings us here to finishes up the present. Let's talk about where we may be going from here. Wow, we could camp out on this slide for quite a period of time. Geopolitical risks. United States and China still not getting along. That's sort of to be expected. Two different ideologies, and who's trying to be the big dog of the world, so to speak. You've got the Chinese aggression toward Taiwan, major cyber attacks from that part of the world, from Russia, etc. And you know, you've got the COVID, now the Delta variant, etc., placing worry, fear, and concern on various governments, the world trade, world travel, and this sort of thing. So geopolitical risks are indeed something that, as we move forward, to be well aware of with regards to the management of funds and the way we look at fixed income, et cetera.
So we think growth can be affected by debt too. Not saying anything that everyone on the call probably knows. Study dating back to 2011 by the Bank of International Settlements says that any government with debt that exceeds 85% of their gross domestic product or their overall economy, historically, that extra debt has slowed growth moving forward. And so after this year, from 2020 to 2021 was one of the largest one-year jumps in the overall debt of the U.S. government, up to about 127% currently. Now, almost a quarter of that is intra-government debt from one piece of the government to the other. But with that being said, still a very high number, and there's a couple of ways to where we can get out of this. Number one, the obvious, well, stop borrowing so much money. That's easy. Number two, we can grow our way out of this. If the country can continue to grow and keep the borrowing at a similar or lower level, it starts to slowly retreat the debt burden as bonds do mature. Or number three, what the government really hasn't said, but what they're in some form or fashion trying to do is inflate your way out of this. And if you can pay back borrowed dollars when the dollar is worth less down the road, that's a way to kind of bite around the edges to pay part of that off. So we're not excited about this. Whether you're red or blue, it seems like both sides of government enjoy spending money, and the markets are not currently concerned about it, but this would be a long-term worry for us. Kind of already discussed this with the inflation, but this is a look at the 10-year U.S. government bond, looking at the past 54 years of history. And as you can see, interest rates tend to work in 30 to 40-year cycles. And so we've had interest rates moving lower now for about 4 decades. We think at some point interest rates move higher. We're not smart enough to know if that's tomorrow, next month, or next year. And if you know the answer to that question, we'd like to hire you. But we've positioned fixed income portfolios to be more interest rate agnostic, meaning we don't want to take this interest rate risk. And as Randy said, when interest rates go up, bond prices do go down. And so we want to be more nimble, more flexible. And that's how most of our taxable fixed income portfolios have been positioned for if and when interest rates do move higher.
Matt, one more thing on that slide, and the real takeaway also is you've heard us or perhaps seen some of our communication on what is affectionately referred to as the 4% rule, the study done by the number of people that said you can take 4% out of your portfolio, ride the ups and downs, and you'll never run out of money. Well, that was predicated, that study, on years and years of information where interest rates were much higher. Bonds were a good ballast. And now we think there's tremendous risk in the fixed income market that hasn't been there in the past. And again, not to belabor the point, but interest rates are a very key variable, and they're a very important input for the management of money, as well as the spender, our clients as they spend money going forward.
Thank you for that. Yeah, well said. Looking here, where's the stock market going? That's a question, whether you're asking it or not, it's in the back of everyone's mind. And we'll get really good comments, questions from clients. Randy, Matt, the stock market has just gone straight up. Valuations are way high. Have you seen the Shiller PE ratio, price to earnings ratio? And this is one of the metrics that people can and will use to see what is the valuation level of the stock market. This is as of a few months ago, but you can see that the overall stock market is at a higher than normal level when you look back at history. Now, with that being said, we think that this is what we would consider an absolute metric, meaning if it was a standalone metric, we would be worried. But in our humble opinion, we think this is more of a relative metric, to where you say what the Federal Reserve has ultimately done, they've pushed interest rates close to zero, and they have forced retirees to not own bonds, CDs, fixed income, cash, just because it's paying next to nothing. They've said you need to own risk assets, or you need to own stocks. And so this red figure you can see here are where interest rates are. And so if you could go out to the bank down the street and get a CD that was paying you 6 or 8%, yeah, we would be really concerned about the valuation of the stock market. But with interest rates so low, with there really not being another game in town, there's really nowhere to look besides the stock market. And so with that being said, we're not really worried that there is a bubble in the overall stock market until interest rates would come up significantly. We've done a lot of study on this, on if the 10-year U.S. government bond, if it reaches 2%, if it reaches 2.5%, 3%, et cetera. But interest rates are still at very low levels, and we don't think the 10-year U.S. government bond, which Randy said was around 1.3%, historically speaking, that does not move from 1.3 to 2.3 overnight. It slowly happens month by month.
And we said, Matt, at the first of the year, we thought interest rates could get to 1.5%, and they blew through. The 10-year Treasury blew through 1.5%, went on up to about 1.7, and now here we are back down. So Yogi Berra, what was it? Deja vu all over again, or whatever. But so stay tuned.
Here's a recession dashboard for clients that have been clients for a few years. You'll remember this. We took a pause at the beginning of last year to do this just because a lot of these metrics were not as valuable during the 2020 COVID time, just with the economy shut down. But we're reinstituting this and going to be looking at it and sending it out by blog on a quarterly basis. But we look at these numbers, and happy to report everything currently is green. Green is good, as you might imagine. And so there's really, from a fundamental perspective, nothing we see as cause for concern. Obviously, we did not see a pandemic really throwing a curveball to the whole country, the world, the economy, et cetera. But with that being said, the metrics that we're following continue to look encouraging.
So we've coined our webinar this morning, the great reopening, what the industry professionals are saying, just like when a Broadway play opens, there's hope that the Broadway play will be good. The Broadway play will run a long time. Here, in case of the economy, we hope there's a sustained recovery and things go as planned. We liked this quote. Less than 1 year, the biggest risks in the markets have flipped 180 degrees. Rather than worrying about a collapse in growth, today, most investors worry about too much. In the process, Treasury bonds have morphed from an efficient and reliable hedge to a source of risk, unquote. Again, we talked about as interest rates go up, bond prices come down, and what if interest rates do move higher? You could take away several years of interest very quickly by just the loss into the negative total return of a bond portfolio. So we are aware of that, and that is something that we spend a lot of time looking at. Another quote here from a gentleman at Trust Company: over the next 12 months, stock gains will outpost those of bonds and other defensive assets, but are certainly less what we've seen over the past 12 months. We agree with that. Single digits, in fact, mid-single digits. We see the economy recovering, the recovery of the economy continuing and being a tailwind for stocks. We think stocks have gotten out ahead of themselves some. And again, even in a bull market, historically, you'll see a 10% pullback once a year. That's sometimes tough to figure out when the pullback that are just sort of normal and ordinary happen. Once every 3 years, you'll see the market on average pull back 20%. Again, those are, you can quote us on this, even less fun than the 10% pullbacks, but we do see the bull market continuing, but not at the pace that it has been this year. So anyway, that leads us to sort of talking about our investment process. If you take away one thing, we think that a process, especially in this day and time, high level of stocks, low level of interest rates, is especially important. It's always important, but we think it's more important today in these times than ever before. Sometimes you'll hear, well, who is your investment guy, or who's your bond guy, or whatever. We think you need far more than just an investment guy. We've designed our practice, the Price Group here, to do holistic financial planning, something that I grew up on, and again, we think is a true value add. You're taking into account not just investments, but retirement planning, income tax planning, estate planning, cash flow, insurance, goals and objectives. Benjamin Graham, who was a guy named Warren Buffett's mentor, said the best way to measure your success in investing is not by whether you're beating the market, but whether you've put in place a financial plan and a behavioral discipline that's likely to get you where you want to go. So this is at the bedrock, the foundation of everything that we do. A lot of people, frankly, don't do holistic financial planning because it's time intensive, and it takes a commitment to do so. We feel like it's our secret sauce. And again, our pledge, our goal, our promise is that we are much more than just the investment guys. And as our tagline, you're probably aware of, everybody needs a wealth coach. We firmly believe that.
We have between 2 and 3 dozen clients on the phone, and so this will be a review for all of you, but the family index number, what rate of return do we need for you to be, quote, successful before leading up to retirement and also in retirement? And how do I get there with the least amount of risk? So a big part of what we do, the planning piece, is we're solving for the least amount of risk necessary for you to be, quote, successful. Like Randy said, based off goals and objectives in there. What this does is it really helps clients replace complexity with clarity by having you understand exactly what rate of return you need to earn before and then also during retirement. And so another question, why do I need an investment process? How much can you spend in retirement? How do you invest a portfolio that meets your specific needs? We've mentioned it already, but discipline and also income generation, we think these are core principles for any retiree. And the big thing that we're looking at, we're big believers in dividend-paying stocks. We have a few blog articles coming out over the next few weeks and into the next few months on this, but income. That's rule number one in retirement, and rule number two is don't forget rule number one. But we're looking to generate consistent and hopefully increasing income. One of our strategies that we will utilize, we call dividend growth. We're looking for companies that don't only pay dividends, but that can pay and hopefully increase those dividends year over year. That's a real tried and true way to see if a company is viable and healthy moving forward, is if they can continue to increase that dividend to their shareholders.
So as I've sat down with folks that are either close to retirement or at retirement, I haven't met a single individual, a single couple who's not interested in three things: clarity, comfort, and confidence. If you have clarity about your situation, that will lead to confidence, and confidence leads to the ultimate desire and comfort, a smooth ride during retirement. Well, the only way to truly get the three C's, clarity, comfort, and confidence, is to sit down and do a written, we call it a live well plan, a holistic wealth plan. We're a little bit corny. We say live well because everybody wants to live well. And so as we sit down with folks, a meeting with us, we think will get you further down the road about your financial future. We'll explain what a live well plan looks like, what degrees of confidence, what some of these terms are. And we think, again, it is the foundation of where everybody wants to be, and indeed our secret sauce with regards to what we do for clients. We love doing it. We call it the aha moment, when people really see that where they are and they exhale, and it's quite fulfilling for us as a team, as we put a lot of work into creating these live well plans, and we think it's time well spent, and clients really appreciate that. So that concludes our prepared remarks. We thank you for your time. Please feel to reach out to us. Questions or comments, email, phone, etc. Matt, I think you've got a couple of questions. People have raised their hands already. Back to you.
It looks like we have one question that's already come in. What is the potential impact of government spending resulting inflation with the money the country does not have? We've touched on this already, so the question might have come in earlier. But yeah, we think it's short term, it's not an issue, but we do have concerns in the medium term and the long term for this. And like we said, we need to grow our way out of it. We need to spend less, and we think actually a little bit of inflation is a good thing. Not stagflation, not hyperinflation, but a little bit of inflation typically means that the economy is growing and interest rates are moving higher. As a retiree, you kind of secretly are hoping for a little bit higher interest rates, just so your bonds, your fixed income will pay a little bit more.
And the inflation can be termed a hidden tax, which means you need to own some equities during retirement. You need to have some growth of capital. Cowboy math, rule of thumb, the rule of 72. If you have 3% inflation, your cost of living will double every 24 years. If you get into 6% inflation, obviously we've had greater than 6 at times during history, and that will double your cost of living 12 years. So this is the discussion for us. How do you prepare for future inflation, as well as still have the income that you need? Great question, and probably the $64,000 question. We're still, again, reacting to interest rates moving lower with some of the spending that's going on. So anyway, if we don't have any more.
A few people have raised their hand. Shoot Randy or I an email with any questions, or type in the chat box. We don't have the ability to unmute people and and have them verbally ask a question. So shoot us an email though with any follow-up questions, and happy to send out the presentation. We're going to put it on our YouTube page. Takes us about a week or two to do that, so we'll get it sent out here in the next a couple of weeks. Here's another, Randy, good question that came in. Should I be increasing the portion of my portfolio in equities? How about you take that one?
Okay. The allocation for an individual family really depends on goals, income needs, etc. Again, we come back to, we're going to solve for the minimum amount of equities relative to what you need to get you there from here. Some people will decide to be a little bit more growth oriented from a standpoint. Mom and dad have plenty of money, and dividend stocks sort of are a multi-generational planning tool. They give this generation, mom and dad, if you will, income for retirement, hopefully increasing income if we've done our job correctly. And they also grow the capital for the next generation. So in some cases, the answer can be yes. And in some cases, why take more risk when you've got everything? Why take a chance? Because a stumble in some of the returns could cause a little bit of hardship. And so this is something that we review on a regular basis as we redo the financial plan. But as Matt said, we are income oriented. We love dividend paying stocks, and we think that is one of the things that really adds to clarity, comfort, and confidence for the retiree.
And one quick thing to add to that, it really depends on what type of fixed income you own. There's a big difference in owning some short-term, high-quality, tax-free bonds opposed to some intermediate or long-term government bonds. And so like we discussed earlier, we've made both our taxable and also our tax-free bond portfolios more interest rate agnostic. So that's a big piece. There's over 14 different types of taxable fixed income bonds that you can own: convertible bonds, government bonds, mortgage bonds, corporate bonds, etc. And so it's really, we think, a recipe effect moving forward. It's going to become more and more important what type of fixed income that we own over the next 5, 10, 15 years.
And one final thing, we sometimes get a call or an email that said, well, I had some questions. I was afraid it wasn't a good question, or I wanted to come see you all, but I feel like that I wasn't educated enough, or I didn't have my information together. We're happy to sit down. We love visiting with people. Our goal is to help, and if we can, I tell people that we'll both know there's some common ground. If not, we'll certainly shake hands, part as friends, and we guarantee you'll leave as a better educated consumer. So feel free to use us as a resource. We've got some things online, and then again, on behalf of the whole team, Maddie, Tiffany, and also Melissa, we're dedicated to the theme of holistic planning within the retirement scenarios. So email address, telephone number is there. Hope to see you soon. Thank you again for taking time this morning, and have a great rest of the day. Bye-bye.